On the eve of the first day of the government shutdown, I am thinking, why hasn't the market tanked yet? This is not just a shutdown event. Preceding it, we have had a lot. Since January 1st, 2025, we have seen political risks that could have historically crashed equities. Constitutional showdowns, executive power struggles, fiscal dysfunction, and geopolitical flashpoints. Add to it tariffs. Yet, the S&P and Nasdaq remain surprisingly resilient. So what gives? Hey all, welcome to Share Trek, where science meets investments, and I'm your host Raj. Today we're going to dig into this question. We are living through what I would call a political risk zeitgeist. The risks piling up today are objectively bigger than many past crises, but equity indices are holding up. That creates a paradox. Fundamentals should look fragile, but investor behavior is telling a very different story. Historically, markets reacted violently to constitutional uncertainty, but right now, investors seem to be assigning more weight to institutional stability. When I say institutional stability, we are talking about the Fed, fiscal backstops, and the assumption that America's system eventually muddles through. There are a few dynamics out here. First of all, I think investors continue to believe rate cuts and fiscal deals will cushion the shocks, even though the outcomes are still uncertain. The second factor is that algorithms, momentum traders, and structural supports are propping up prices independent of fundamentals. ETFs and index flows also constitute the third aspect. They continue pouring money into equities, creating almost automatic buying pressure. This is where we talk about zombie companies being propped up by ETFs having systematic investment going on. And then comes the last factor. Many investors see the risks, but they are waiting for a clear signal before selling, betting that the equities can grind higher until a true crisis or a catalyst emerges. Friends, if you're finding this breakdown helpful, please press the like button. It helps more investors like you discover this content. Well, coming back to my story, I would say that gold tells the other story. Here's where it gets interesting. Safe haven assets are screaming caution. Gold is at a record high. As of October 1st, 2025, we are seeing gold in the vicinity of $3,890. That's not random. It reflects investor anxiety about multiple risks: government shutdown threats, weak employment data, sticky inflation, geopolitical tension, and uncertainty around the Fed's next move. In other words, systemic risk is being priced, but just not in equities. This creates what I would call a dangerous financial disconnect. Gold and safe haven assets are at peak fear levels, while equities are shrugging it all off. Historically, these disconnects don't last. They often resolve with equities suddenly catching up, and usually in the wrong direction for bullish investors. So, while markets look resilient today, that resilience could evaporate quickly if a shock forces the adjustment. Now, I personally have been shorting the market for 3 months, I must confess, and it's been very painful. And I sold the last of my longs yesterday, so I'm mostly in cash and shorts. And looking at what's happening today, I think that I have misjudged the market momentum and the strength of the market, and I think I'm in for more pain. But I can't believe how a part of the market like gold and Bitcoin seems to be pricing in the risks. And on the other hand, equities seem to be shrugging the risks altogether. When the market opened this morning, it seemed like finally the market was going to listen to it because the pre-market was negative. But right now, when I'm making this video, I can see that the indices are going into the positive. I would like to hear from you guys. What do you guys think? Please put your thoughts in the comment section. And before I leave, I'd like to thank you for watching this video. I request that if you have not yet subscribed, please subscribe and help us build a community of retail investors who can share market intelligence and ideas so that we can do better in the market going forward. Well, this brings me to the end of the video for now. Bye for now. See you in the next one.